So this is a trade review video that I'm going to do, and the reason why I'm doing this review video is because I've traded since 2019 and till 2022 was failure and lesson. 2023 was a journey of growth where due to all of those failures I see immense growth in my performance. I started an evaluation account from TradeXProbe, a company based in Sarawak. I passed it in May 2023. It was a $5,000 evaluation account. Eventually, I lost it in October because I was inactive for 30 days. Since their policy is if you're inactive for 30 days, they'll pull back the account. And currently, I am going through an evaluation phase for a $10,000 account for a bespoke funding program. And the reason why I'm mentioning this because in my opinion, it's not easy to pass an evaluation account. If you take 20 people in one room, only one of them would pass, and I managed to do that. Where at first there were 10 of us that started together, friends and cousins. Only I stayed behind, and if you were to tell me that I wouldn't be making money for the first 3 years, I would be losing money and be in a constant journey of lessons and failures, then I would probably say no to this journey. But seeing how I am growing in a well-mannered way, trading-wise, all I can see is that I just need time to accumulate capital. So I'm doing that with a proprietary firm. Okay. And the reason why this backtesting video is here is because I'm going to blindly backtest 2023 trade data, so you'll see on how I trade. Okay, not every trade will be a winner, as you'll see in this series, because we all know that the financial market is unpredictable. All we can do is risk manage and take our trades based on our plan and our rationality, and that's how in the long run we can accumulate profits. Okay, and also it serve as a track record, because if I were to have a track record for 2024, once I pass the bespoke funding program, which is most probably this month, January 2024, I will put that live as a track record in my FX book, and at the meantime 2023 data will serve as an idea of how my track record would look like. And I'll be fully transparent, as you'll see my winners and my losses throughout the whole year. Okay, so sit back and enjoy this first episode to this edition right here. Okay, so firstly, let's start from DXY. Since I trade GBP USD in the London session, I always like to correlate DXY together, because I do believe that anything you're trading, if there is the US dollar in it, you should correlate it with the DXY, which is the dollar index chart. So firstly, I'll start from the weekly time frame, and I only touch this weekly time frame once a week. Okay, so first we had this extended push to the upside right here, and then we had this movement to the downside for a couple of weeks, and currently we can see prices in this area. Now what I like to do is see where is price currently drawing into. Okay, for me this is a fair value gap area. Now what I meant by fair value gap, a fair value gap area means that there is an imbalance in price. There's inefficiency in price, where price move impulsively and there's only one participant in the market, and what price likes to do most of the case is to retrace towards that area to fulfill the market inefficiency. So we can see how we sort of went to the fair value gap. We swept the previous weekly low right here. Okay, and then what we can see afterward is a displacement to the upside right here. So what can we tell from this? Since we failed to displace below previous lows, there's a huge chance that we might take out the previous high, as that high is considered a weak high, and this is the same vice versa. So we have this high right here, and then we have this high right here. I won't go into details for the XY that much because I don't want this video to be long. So if we go to the daily time frame, we can see how we had a break of structure, and then we can see this move to the downside where price retraced to a discount, and discount and premium is generally determined by if we're in a bullish price leg, did we retrace below the 50%, which I will show later, or a premium is if we are above 50%. So it makes sense where if in real life, okay, if you're a customer, you would buy things for cheap when they're in a discount, and if you're a seller, you would sell things when they're in a premium price as you'll gain more profit. It's logic in real life and it's logic in the markets. So currently we are in this demand zone right here. Let me do this first. Because this is a fresh account, so I don't have my previous setting. Retrace towards a discount in the time frame, so what we could expect is price to be bullish. And in the daily time frame, in the 4-hour time frame, you can see the area where price mitigated. Now we do see this is a corrective movement right here, okay? But if we look at the daily time frame, we do see that this was a rejection, so we should not get blind by the lower the time frame we go into. So we do know that this is a rejection, because most people would usually think price is corrective, why don't we sell from here to bring price to the downside. If you look at the bigger picture, this is a rejection right here. We had this movement to the upside where we tried to displace after taking this low right here and mitigating a certain area right here, judging from this candle right here. So it looked like we could be bullish, coupled by the fact that we are in a discount. Then we allow ourselves to go to the lower time frame. If we have a clear bias in the higher time frame, then we can allow ourselves to go to the lower time frame to ensure that we trade less on the flawed bias, so we could avoid losses. So we could avoid more losses. Okay. So if we go to the lower time frame, we can see how from this point right here, we had broken structure. From here, retraced to a discount into this fair value gap, had a push up, price retrace right here, and we can see that in that retracement, price respected this low and had a movement to the upside. And in Asia session, we retraced back to this demand zone right here, had a reaction and had a move to the upside, judging from this right here. So I'm clearly bullish on the XY. So for GU right here, we could potentially look for bullish, and we could potentially look for bearish setup, because GU and DXY, they inversely correlated. So for GU, I'll just start in the daily time frame to avoid the video getting too long for now. Daily time frame, straight off the bat, I see equal lows, and equal low means that there's liquidity below this area right here. There's a lot of people stop loss because there will be a lot of buyers trying to buy in this demand zone as a break and retest trader. So for me personally, I trade supply and demand and liquidity. Where is the liquidity? That's where I'm targeting. So currently we have sell side right here. I'm bearish for GU. We are in this supply zone right here. This is the supply zone we are currently in. We took previous daily high right there and failed to continue above. Everything looks bearish. If we go to the 4-hour time frame, we can see how price swept previous high, attempted to push to the downside. Now I believe that price does not move out of no reason. Price move from one area to another because liquidity is like a magnet. Secondly, liquidity is like a fuel also. If we see that there's an impulsive movement at a certain direction, it's highly likely we have just swapped liquidity, such as explained in this scenario where we took this previous high, expanded to the downside. So I'm bearish for GU, clear buyers, clear liquidity sweep. If we go to the 15-minute time frame, if you're noticing what's this color boxes for, well, for me, Asia is black color. I just said it because it's easier for my eyes since I trade the London session. Asia is the black one, London is the red one, and New York is the green. That's my preference. So we could see Asia session swap previous high, displacement to the downside, retracement towards this area right here, and then we had another break of structure from this area. So what we could do is, now we do see our buyers in play, very clear. We could enter a trade, a sell trade. So what I like to do is, to take this Fibonacci retracement right here, and what I usually like is to enter anywhere within, if I'm selling in a premium, if I'm buying in a discount. So firstly, since I want to sell in the premium, it must be above 50%. And what I like to also do is enter where price is the cleanest. What I meant by that is, for example, the 50% has been mitigated, the 0.62 has been mitigated, but the 0.7 is not mitigated yet. This might sound confusing at first, but that's how I like to trade. I like to enter where price is clean, where it shows inefficiency, because in my mind, price is drawn towards inefficiency. And my typical risk to reward, how I do it is, if I were to enter the 0.62 area, this is an example, and I always target a minimum 3%. If I were to enter from the 0.62, the reason why I'm doing this, because if the 0.62 in this case is already mitigated, I would use the inefficiency area, which is the 0.705. And what this do is that it maximizes the profit by having a tighter entry. So from a 3%, we can gain 4%. So for this test, I run on a $10,000 account, because that's the evaluation account I'm currently running in bespoke funding. So for all the example, it'll be a $10,000 account. But if it were to be 100 or 200,000 from a prop firm account, which you can get it yourself, the result would be different. For example, for a 10,000, a 4% gain would be 400. If it's a $100,000 account, a 4% gain would be a $4,000, and the rest you'll do the math. So from here, we can place our order, save it, and since I trade the London session, it's currently 8 AM London time. This is the New York time, but if I were to change to London, it's currently 8 AM. So we can see how price, and my window is from 8 AM London time to close to 11:30 London time. This hit us at 10. And what I like to do is, how I risk manage if price move below this low right here, and that's where I usually put the trade to break even. Okay, seems like for this example, we do not need to put the trade to break even, because the next candle that went down instantly went to our take profit. So in general, this is our trade: break of structure, supply and demand, liquidity. But I do want to have a disclaimer here, where not all trades will look like this. There'll be losses, which you will see in this series, and there'll be winners. So whoever is watching this, do know that every trade carries a risk, and this is not a financial advice of any kind, because I do believe that when you're trading, it's your own risk.